Well, welcome everybody.
Wow.
So finally, you're keeping an eye on the waiting room, right?
Yep.
Awesome. Hey guys, welcome everybody to this inaugural series of the Knowledge series. Very excited to have you all here. And while we are setting up, while the others are joining, let's give them a couple of minutes. In the meantime, can you guys please type in the chat room and let us know where you're from? I know we have people from all over the world. The panelists are from all over the world. So if you can just see where people are from, that will be really great.
Well, nice.
Okay, wow. Portugal, Singapore. So lots of Singapores, obviously, Malaysia, Portugal,
Vancouver.
Portugal. Manuel, I see you have a large contingent from
Yeah, but
Portugal.
Singapore is winning right now.
Singapore, yeah, Singapore will probably win. Anyway, okay. So while people are telling us where they're from, let me do a quick round of introduction. Matthew, thank you very much for agreeing to join us this evening, afternoon, or morning. So guys, Matthew Peterson is the managing partner of Peterson Capital Management, LLC. It's a concentrated long-term value-based fund with over a decade of track record, generating a 17% annualized return. So that's fantastic. Now, before this, Matthew split his time between Wall Street and London as capital markets manager at the Diamond Management and Technology Consultants. And his expertise spans risk management and derivative processing. Uh, Before this, he has also worked with global financial service firms like Goldman Sachs, Morgan Stanley, Merrill Lynch, American Express, Ameriprise Financial, etc. Matthew, welcome. And
Thank you very
before
much,
we
Rupam.
start,
It's a pleasure to be here.
thank you. I'll do a quick introduction to our other panelists here who have, kindly agreed to join us today. So we have Manuel Mauricio, who is joining us from Lisbon, Portugal. Manuel is an architect who was looking for ways of investing his massive wealth, and that's when he got bitten by the value investing bug. And I think there has not been any turning around since then. Manuel is also the founder of allinstocks.com. If you guys haven't checked it, do check it. He is extremely thorough with his research, and I have read his research, and I look forward to seeing whatever he comes up with. That's Manuel, and then we have Jonathan. So Jonathan is an American, but he lives in London, and he is a new father. So Jonathan was not sure whether he will be able to join, because Jonathan, I think your little one is still in the hospital or not yet home.
Yes. So William Wallace, my son, was born only at 25 weeks of gestational age, but he's doing well. He and mom are doing well, and he's got strong lungs, a strong heart, and we're very optimistic and very grateful to have him.
Fantastic. So Jonathan has a very interesting background. By the way, I mean, all the panelists have very interesting backgrounds. Jonathan actually is with the US Navy. He's a submarine officer, and he is right now based in London, but he's also an avid investor. He is someone who does absolute deep dive research. In fact, when I see that Jonathan is researching the same company that I'm looking into, I take the lazy route and I wait for him to publish, his financials so that I can go and, look at it. Because if he has already done it, then, I can be sure that he does a very thorough job. And
Pressure's
then,
on.
then we have our own Vaibhav. Vaibhav is our business partner in MoneyWiseSmart. He's again a full-time investor, lives in London. Two of our panelists are from London. Vaibhav and I go back long back. We actually went to the same engineering institute together. That's long back. And
Don't give
after
our
that,
age.
of course, yeah, after that, we lost in touch. But, thanks to internet and social media, we
And COVID.
our investing principles brought us together. Vaibhav runs his family office out of London. In the past, he has worked with Citibank in their derivatives operations business, and then he also was involved with his own technology business, which he sold, and now he's a full-time investor. And then I have my co-founder, Fan Liang. Fan Liang, he just got back from Melbourne, Australia, where he was based, but now he is back home in Malaysia. And today, while you all are in mute, if anyone has any questions, please feel free to type it in the chat room. Fan Liang will be compiling all the questions for the panelists. So without further ado, as I have the mic, I get to ask the first question. And Matthew, you're on the hot seat. I hope you have your coffee ready, everything sorted. So
right here, ready to go.
Awesome. So very curious to know from Goldman Sachs, Morgan Stanley, from Wall Street, how did this shift into the buy side happen? What prompted you to start your fund? If you can tell our viewers a bit about your background in your own words and your journey.
Yeah, absolutely. Well, I had sort of set out from an early age to run a fund, and so I don't necessarily consider it to be a major shift. It was sort of in the cards and in the plans, and I went to a small liberal arts school in the Pacific Northwest, which is Seattle, and called the University of Puget Sound. I studied economics and math, and basically tried to, went out to Wall Street after school. I spent a little time in Beijing, China, and then I went out to Wall Street, and I was sort of just putting the building blocks in place. And so, ended up consulting for a whole bunch of investment banks, primarily Goldman Sachs, and spent a couple years over in London. And I was also earned my CFA designation during that time. And in 2010, left that role and, I guess for a little bit more background, I was always fascinated by Warren Buffett, value investing strategies in general. And in 2004, I made my first pilgrimage to Omaha, Nebraska, to the Berkshire Hathaway annual meeting. And I've been almost every year since, except for a couple of years I was living in London. And then this last year when COVID caused it to be remote. So I've been attending those meetings for almost 2 decades now. And in 2010, I moved out to Los Angeles and launched my firm. And, with a long-term concentrated value-based strategy. And the rest is sort of history. So in January of this year, we made a very nice move out to Austin, Texas. And it was a very timely move. And so here we are in Texas. And yeah, I can go into any amount of detail you'd like on any of that.
So what's your preference, Matthew? I mean, deep undervalued businesses trying to make a return from mean reversion, or growth businesses, looking to hold them for a long time? Because here, among our viewers, we have both types. So which type are you?
That is a great question, Rupam. I think, I'm a combination of both, and I'll incorporate each into our portfolio. And in a way, you get diversification simply by having both in a portfolio. It's much more challenging to find them, but when you can find a long-term Fisher type compounder, that is a greatly preferred strategy. It's better for the long-term IRR, depending on your jurisdiction. It's better from a tax perspective, typically, because in the US, at least, anytime that you switch securities, you have to pay shorter long-term capital gains tax. And so you have to re-catch up to your old high watermark after those taxes are paid. So it's certainly beneficial to find a long-term compounder. If you can get something that's in the high teens, 20 or more % in growth and just sit and do nothing for many years, that is a wonderful business. It is, there's just not very many of those available. And so a lot of times if there's something that's completely mispriced and it's not growing quite as well, we will take the same Graham approach. We do very deep value analysis, fundamental analysis. And certainly if something looks like it's, has a double or triple over the next 12 to 24 months, it's still very attractive for us. So it's a little bit of a combination. And I think taking kind of looking at things through both lenses is important. So we're often from a Ben Graham perspective doing analysis, and then we're also looking from a Phil Fisher analysis, and we have both.
Does it make sense to differentiate businesses into value and growth when it comes to long-term investing, or the end results are the same if the businesses are compounding?
That's a great question as well. I think in general, the media and talking heads and a lot of people around the world sort of bucket things into the two systems between value and growth. And I think it actually causes a lot of problems for many value fund managers. So if you were to say, do a screen, and screenings, I'm not really a big advocate of screening, but if you were to do a screen and then just automatically sort of, eliminate any firms that have some high multiple, you're going to miss a lot of the great companies. So, you have to, as Buffett says, you have to look through the windshield, not through the rear view mirror. So if earnings are growing, it just fundamentally changes the intrinsic value of that business.
Okay.
And so if you really understand, you need to really understand the business. And certainly we've missed a lot of the high flyers of today, from Amazon and the FANGs and things. They always looked quite expensive, but if you really understand those businesses, there's a value aspect to them. And so I think it's fair to say these are priced more like there's growth, and these are maybe priced like there's less growth.
Yeah.
But frankly, I'd rather be in a slightly undervalued situation where it's growing strongly than to just be in sort of a melting ice cube type business that's trading for 50 cents on the dollar. And so, they do tend to get bucketed, but as you'll also hear from Buffett, growth and value are connected at the hip, and growth just changes the fundamental. If earnings are growing and something's trading for a PE of 25, and you expect earnings to be twice as high in 2 years, your forward earnings is now 12 and a half. And so it's just a factor that needs to be incorporated into the analysis.
Great answer.
It's very interesting that you say this, because just I think a couple of weeks back, I'm not sure whether you read the latest memo from Howard Marks. I mean, he exactly talks about this, and someone with his background, it was very interesting to see a 74-year-old. I mean, how intellectually flexible and agile he is, because he actually got influenced by his son. I think his name is Andrew, and and we were just this guy. So during COVID, he got to spend a lot of time with his son, and just imagine the sheer intelligence around the dinner table. And after that, it was a long memo. And I personally think, I have read most of his memos, and I personally think that it was by far the best one. And he exactly brings out, this point. So, and yeah, I think this is also very relevant for this particular group, because, here we keep discussing, high growth business, and sometimes we also wonder that, but they look expensive. So, I mean.
And if you consider the demographic of our group, I mean, we can see from our poll right away that we have mainly intermediate people in this audience, and between 2 to 10 years of investing experience. So it's a very nice mix. And I think these questions do bother this audience, whether what is value, what is growth, etc.
Yeah. Well, I did see that memo, of course, and I am very fond of Howard Marks and his writings and his books, as well as many others. And so I completely agree. And I also think it's very important to keep an open mind. There, I have friends all over the world that are in the value space, and I do find that, and I'm guilty of this to some capacity as well, but I do find that those that sort of approach new opportunities with a closed mind are missing opportunities. So I don't personally, for example, participate in any of the cryptocurrency, but I'm not really against it. It's just not something that I find value in, and I find other opportunities. And so I have the luxury of being able to skip over certain aspects. But yeah, there's a whole lot of products out there, and if something looks valuable to you, then there might be some value there.
And Matthew, were you always like this, or did your style evolve over the years? I mean, because considering your background, Goldman Sachs, Morgan Stanley's of the world, to what you're doing now, I mean, I guess it has been quite a journey. So how did your style evolve?
Yeah, it has been quite a journey. Well, I can sort of share. So I think every investor's style evolves over their lifetime, and but there are some sort of special, I think, almost hacks that I've identified and figured out that I'm happy to share with this community. But yeah, when I was always a value-oriented individual. So whatever I was purchasing, I didn't want to overpay. And so, having that sort of innate quality, I think, is very important if you're going into portfolio management and looking for value opportunities. I mean, I think it truly needs to be part of your personality. So no matter where I was, I still had that bent and orientation. But it's a big question. So I can share some early sort of insight that occurred to me back when I was on Wall Street. And I can also sort of share how things have evolved, I think, over the last few years, because I do recognize more over the last few years that basing things on, say, book value is maybe less beneficial in the new economy. So you actually can create cash flows without having a major factory. And that's a big change, in the last sort of decade or so. So I think people do need to sort of adjust their mindset and pivot. But to further, to sort of set things back in the framework, when I was out working on Wall Street, the hours were very intense, and I still wanted to be doing my own research and managing my own portfolio. And I came across this academic article that proved that there was alpha in doing the most simple process, which was just to look at the Berkshire Hathaway 13F and evaluate what Warren Buffett had bought in the last quarter, and sort of buy what he had bought. And if he was selling something, then you sell what he had sold. And they went further, and they waited something like till the end of the month after the 13F report came out. So for those, just for clarity, if you have $100 million fund or more, and it includes firms and Berkshire Hathaway and any corporations that have assets, you file a 13F with the SEC, which basically discloses a snapshot of your current position. So you can just compare one quarter to the next and look at any changes in any firm. And so this academic article proved that just simply by cloning what Buffett was doing, you actually outperform the market. You actually outperform Berkshire Hathaway as well, because the newer positions were outperforming the legacy positions. And when I was sort of, I think, there was 1 hour we put in like 104 hours in a week. There was no time left to research the things that I was really interested in. So I needed to find a major shortcut. And as soon as I read this, it really resonated with me, because I realized you could look a lot further than Berkshire Hathaway. You could just go and look at, all the greatest fund managers that you follow, and you could see what they're doing on a quarterly basis. And it wouldn't work in like a high frequency trading situation, but it really works well in a scenario where you have a very concentrated portfolio with very low turnover. Somebody like Bill Ackman takes a position for many quarters, perhaps many years, after spending hundreds of thousands of hours and maybe millions of dollars doing research. So it's not something you need to immediately clone, but it becomes very interesting. So it's a very, very nice shortcut to sort of get into that. So that's kind of where I started, in terms of just like hacking through and finding, Charlie Munger always says you have to fish where the fish are. And if you have the right pool of managers and you're watching what they're buying, you narrow things down and you have a few hundred companies, you've now isolated, a few hundred out of maybe 10,000 opportunities to research. And now you're fishing where the fish are. So you start learning what the great business models are. You start seeing who the great management teams are. You are just really right where the action is. And so, regardless, we still do that today. I mean, that's how we sort of, instead of doing a screen or a filter, that is a much more effective starting place. And but yes, to your point, originally, I think most investors take sort of a forensic accounting perspective when they start, and it's Ben Graham all the way looking for, not most investors, but most value investors. They're looking for, 50-cent dollars, and it's just this rinse and repeat. And you look at reversion to the mean and something that's trading at a discount, and it doesn't quite make sense. Sometimes there's someone's called value traps, and you sit there earning nothing for a long period of time. And I think over time, you start to learn much more about the importance of the underlying business models, how the business models will evolve themselves in a future economy. And then you start transforming to more of the Phil Fisher type investor, where I think you can sort of allow yourself to maybe disregard a low book value, because you can see that cash flows are going to grow. And even if they're, have negative earnings today, you can see that the earnings are, of course, going to be very positive in a couple of years. And so that's sort of the evolution that I think many value investors take. And we're, of course, on that track as well.
In fact, it's very interesting. Just Jonathan, you'll remember just a few days back, you and I, we were having this discussion on your group, the Mr. Market Irregulars. By the way, Jonathan is a founder of that group. You guys should check it out. I think one point which lot of ardent Graham followers miss is that even Ben Graham made a lion's share of his wealth from a high quality business, which is Geico. So and he has made more money from that one business than all his other cigar butts put together. So that's that's the interesting thing to note here. Jonathan, you might have a slightly difference in view. I mean, I'm dying to. I was dying to poke you. You know, to.
Yeah. No, you're absolutely correct. You're 100% correct. I mean, if it wasn't for Geico, then the Graham's performance wouldn't be what it is. And you know, he got kind of dragged or at least keeping it with, you know, kicking and screaming. Not really, but you know, I mean, Buffett and some of the other people he knew basically had to convince him to stay in it, you know, for a longer term and, you know, not take his classic approach. I think the importance here is to have, as Matthew was saying, have flexibility and an open mind. And to me, that is, maybe you have like a Peter Lynch style playbook where it's like, okay, the market's going crazy. People are fearful. They're just selling everything. They're not discriminating what's going on. Maybe I can get a basket of net nets, you know, and the strategy, you know, like right now it won't work because it's hard to find them, at least in the US. But, or maybe I could even get, you know, compounders that are at huge discounts and I can get in at my entry point there. I think you just got to have that playbook ready and be ready to take advantage of the opportunities you see.
That's a great point. I think that's a fantastic point. So Matthew, let me ask you this now. You know, that very famous anecdote that Peter Lynch, you know, in the 13 years that he ran the Fidelity Magellan Fund, I mean, you know, an absolute amazing return of what, 29 odd percent. CAGR decimated the S&P, but when you look at the average returns that his investors in his fund generated during that period of time, you know, most of them actually lost money if you compare it with, you know, the opportunity cost of just putting the money in. And that clearly happened because, you know, most of the investors, they rushed in when in years when his performance was fantastic, and you know, they kind of sold when you know, the performance was not that great. Now, as a fund manager, do you have this challenge? Because you know, while you must be salivating when you know, a COVID kind of a March correction happens, but how easy or how difficult is it to explain to your investors?
You know, Rupam, the animal spirits are very real. They're alive and well. And it's really a lesson in human psychology and the herd mentality, and then the underlying inability to time the market. Sadly, most people don't know what they don't know. And so they are either trying to sort of game the system, or they think they're or they think they have more skill or know something that others don't. We have, in general, we have very high quality, long-term oriented partners. So you know, it's a partnership. We have limited partners. That said, there are always a handful, and people come in and they go out, and I see people do exactly the opposite of what they should be doing on a very regular basis. I think it's part of my fiduciary responsibility to try to keep them informed. So I try very hard to be transparent in our letters. I try to go out and make clear things that are going on. In March, actually March 25th. So at the bottom this year, I sent a special memo to all of our partners, and I titled it "Fasten Your Safety Belts." And I told them that this is the best time to invest since the inception of the fund, because of all the stimulus happening and the amount of fear going on. It's just so rare. Typically during the height of a crisis, you get the largest transfer of wealth, and we were in it right then. But still, you can't help everybody. And so people become excessively fearful and excessively greedy. That's actually what's causing the swings in the market in the first place. So you end up with a few clients that leave at the wrong time, and others that won't join until the very top. And it's quite interesting. I mean, I can give you just such a clear example of this. Happens quite regularly, where I'll meet a new LP, and a lot of them will join when they'll do their research and join the fund. But sometimes there will be somebody who's very interested and capable of participating, but they want to watch the fund in real time for some period of time. And I try to explain, I question, what are you looking for here? Because the portfolio actually is not changing. So would you prefer to see it go up, and now you're going to buy in to the same securities at a higher level? Or are you hoping that it goes down so that you can get the securities at a cheaper level? And of course, psychologically, what they want to see is the fund doing well and going up, which basically means when they join, they come in at a higher level. And if it were to decline, then they won't come in. And right there is just a clear example of, folks, just human psychology, following sort of the trend and doing truly the opposite of what they should be.
So you kind of then say that there's no point looking at your portfolio in real time, 24/7, and trying to micro tweak it for the things, or you feel that once you have taken a decision and invested into a value business, a good business based on research, then you give it time to let it bear fruits in future?
Yeah, that's a great question. So there's a couple of different things embedded in that. I think there's a difference between somebody investing in a fund and somebody managing their own portfolio. So although I'm not tweaking and making changes on a regular basis, I'm paying very close attention to the underlying businesses within the portfolio, and I'm watching them daily. I'm seeing, I'm intrigued and fascinated by them. It's just my passion. So I'm always following them. But for someone who has decided to participate in a fund, they're delegating that responsibility. So then certainly they can specialize in whatever endeavors they want to in their life. And some of them want to manage a bit of their own money as well. So that's absolutely fine. But yeah, I think it's a danger to be tweaking things all the time. You run the risk of making a mistake. And in fact, I think the best practice is probably not to look at your, not to say open your brokerage account. Maybe the securities you own, you can go look them up in the news. But unless you're making a transaction, I don't think there's a good reason to be in some brokerage account clicking around. They are designed by nature to make you trade. So every ding and bell and green and red flash impacts your human impulses to make a transaction, and so you need to set up controls so you avoid that.
Exactly. I mean, in some of our Facebook group, one of the point I noted was most of the brokerage accounts, they never address you as investor. They always call you a trader, dear trader.
Yeah, that's right.
That's why I use Vanguard. It's simple and it's boring.
Yeah, boring is good. As the story goes, that this large broker, they wanted to analyze the relative performance of different demographics of their customers, and they realized that the group which had the best return are the ones who have died. I mean,
it was the deceased, right?
Yeah. So they're no more alive to keep tweaking around. And the thing is, look, it's probably easier said than done, because at the end of the day, I always think of it like this: there are two things that you can know. One is the business, and one is the stock price. The stock price is much easy to know. All you have to do is log in, or you have it on your fingertips on your phone. Whereas a deep understanding of the business requires, a lot more work, a lot more reading. So most people, it's not unusual that most people take the easy way out, and their entire mental makeup, it gets everything gets dictated by the green and red movement of the tickers. In fact, in our subscription group, there's one business that we had researched. Okay, by the way, sorry guys, I completely forgot. There is something I should have said right at the beginning, that in this panel discussion we will be discussing some specific companies, but it's purely for education purpose. Nothing that Matthew says here or any of the panelists say here is a recommendation. It's not a recommendation to buy or sell. So please do your own due diligence, and it's purely for education. So yeah, so coming back to it, so recently, there has been some news, and the share price took a dip, and I could see a lot of panic just because of that. The fundamentals haven't changed. In fact, I'm very soon going to publish a report which actually shows that fundamentals have actually improved. But then, I guess it's like whatever the information that's most easily available, which is the stock price, that dictates how we feel on that particular day.
I got a question for you, Matthew, related to this. And by the way, thank you for being here. And I really enjoyed your podcast with Toby Carlisle. So related to kind of the animal spirits and the psychology and the errors, and, it's like you said, the systems are kind of designed to get you to trade. What do you as a fund manager do to manage your own personal cognitive biases and to make sure you don't fall into, kind of cognitive traps? Do you have a active strategy you use to try to manage that?
Yeah, I do. I don't go in the brokerage account.
Nice.
It becomes a bit, it's a bit of a personality type, but it becomes a bit easier if you truly have a really concentrated portfolio. So, years ago, I did an analysis, and I did a little, I spoke about this at a conference out in Switzerland, and I did the speech I gave, I think I called diversification versus diversification. And it was all about the Kelly criterion. And basically John Kelly, back in the day, maybe the 1940s, came up with this formula for transmitting telephone signals through the line. And they needed, the precise amount of transmission to have it show up, but it doesn't need to be perfect. It just needs to be audible. And so there was a formula that he came up with that maximized this transmission. And it turns out it worked really well in Vegas. And the formula basically said, if you have a fixed pool of capital, which is what you have if you have a portfolio, and what you're going to get, what you're going to win when you're right, what you're going to lose when you're wrong, and the odds of being right, and the odds of being wrong, you can have a very objective capital allocation strategy. And the problem is, it works really well in a game like blackjack, where you can just calculate the odds. But in finance, you just simply can't calculate the odds very well. It's still subjective, even though I may think I'm going to be right, and I'll have this sort of return. There's still subjective nature. So I inverted this whole problem because it hadn't really been looked at. I couldn't find any data on it, but it hadn't been looked at in a long time. And when John was doing his calculations, it was like punch card type calculations. And so I just opened Excel, and I just solved for all of the possible parameters. So I said, from being 100% positive to being 0% confident that will be up, to having 4x returns, to having 0.0001x returns. And I just populated a massive spreadsheet and realized that based on the Kelly criterion, the optimal position size is between 10 and 50% of your portfolio. And so once I had that knowledge, and this has nothing to do with volatility, right? As you get concentrated, you do have more volatility. But it became very clear that if you want to outperform, you need to have just a very few, very solid, great ideas, and you can stick those in your portfolio and watch them for many years. So if you have a truly concentrated portfolio of, 10 or so holdings, I think you transact less, because it's a very big decision to like sell 10% of your portfolio and then change entirely into a new position. So that in itself is very valuable. And again, it might be personality type, but understanding deeply that concentration is the way to run capital properly helps with the sort of tinkering and trading that interferes with a lot of people's success. I'll tell you, the hardest thing in many cases, people ask me quite often, what's your process to buy? And we do have a great process. It starts with this 13F analysis and fundamental analysis and all these things. But realistically, buying isn't really the problem. There's always ideas out there. There's things that we can research. There's attractive opportunities. It's really not selling that is much more difficult. So you can imagine if Graham had just sold Geico, or if Buffett had sold, you could argue maybe Buffett had been holding Coca-Cola for too long, but all of these things could have been trimmed when they looked fully valued, and there wouldn't have been nearly the success. So the selling discipline is really critical.
So you kind of picked up my next question, which was, when do you sell?
Yeah. And do you trim? Do you trim if something gets high weight?
You're asking really great questions that are, and there aren't easy answers. There's subjective answers. So there's things to do sort of in principle. Well, I'll describe. So generally when I sell a compounder, and when we sell, we're usually writing covered calls and selling through calls. Typically, unfortunately, I regret it. And that's just the fact. So I think by and large, because we have a pretty unique, I don't know if it's that unique. It's actually really simple. We have a pretty simple framework, where we sort of focus on quality management, high quality business models, and valuation. And when you get all those right, and you have a great management team involved, it seems like when things become fully valued, the high quality management actually creates more value. And so, just to be frank, as I've sold things over the years, I typically look back and realize I left a lot of money on the table. And so, yes, so that's part of it. All right. The other challenge, and the thing that you asked, is, do we trim? And so the idea in principle is, you don't cut the flowers and water the weeds. You let your winners grow, and they might become enormous. But as they become enormous and they grow, your portfolio does quite well. The challenge is, and maybe this is too much detail, but the reality is that when you have, so we do let things grow quite a bit. If you know a company, I'm thinking of a specific example, and maybe we'll address it, but if you have a company that grows quite large in your portfolio, and you really understand the dynamics of the business, and you can see, like you really understand. So I can see, oh, it's really like the price might sit here for a really long time, or it could even have a large drop, something that I could handle, but my clients or limited partners won't be able to handle. It becomes a really difficult situation because I know that even though in principle holding it is the right thing, it might create a quarterly 25% drop in the portfolio, which will cause panic among the group, all of my partners who don't have that same amount of detail. No matter how much I explain it, it doesn't get through to many people. So in your own portfolios, yeah, you probably don't trim very often. Sometimes we're in situations where trimming is a little bit of a necessity to sort of protect clients from their own psychology. So I don't know. I'm kind of hedging a little bit here, but it's just the reality of the situation. When you get positions that grow to 25, 30%, sometimes it's okay to take a little money off the table.
I think that's fair. I mean, it's not an easy question. I think I'd heard that, Claude Shannon did like a coffee can portfolio, and one of his holdings at the end of his life was like 80-something% of the portfolio.
Yeah, that's right. So that's what tends to happen if you truly stick to the principle, and you'll do probably quite well. You can do well with trimming and finding another idea also. So you don't have to let it get quite that big. But in principle, yeah, you should let it, you don't cut your flowers. If there's something compounding due to the business model and the management team, you should probably let that compounding continue. You just don't want to interrupt it.
Sorry. Go ahead.
But management probably has found great uses for that capital, which is why that compounding would be continuing. So if they're able to reinvest that capital at, very high ROEs, and they're doing smart things with the money, it's great to just let that grow.
I mean, I guess, again, it boils down to how deeply one understands a business, right? I mean, the irony is the richest people in the world have the most concentrated portfolios. I mean, ask Jeff Bezos, so he's not going to sell Amazon stock just because he needs to rebalance his portfolio. So the deeper you understand the business, the more you can think like a business owner. And the fact that, one company has become, let's say 60% of your portfolio, it doesn't worry you. It will worry you if it's just a black box for you. So, that's where I guess all that urge to trim and rebalance comes in, even though, mathematically it may not be the most optimal thing to do.
Yeah, I mean, if I can comment on that, first of all, so that's correct. Of course, folks like Bezos have very concentrated positions, but there is some survivorship bias, right? So there's a lot of folks out there who tried that approach, and you don't know about them because they didn't make any money.
But they didn't make it.
So
That's stuck.
The challenge with having a concentrated, that level of concentration in a fund is that although you may recognize that you're going to have 30% IRRs over the long term, if it's up 100% in 1 year and then down 50% and then flat, and then you have to wait 3 years, people become really impatient. And so that's truly the challenge with when you're running a fund and you have LPs. You have to be willing to sort of go against the grain, and in many cases we basically do, and we are, but that's where trimming happens.
I think Manuel, you had a question. I saw your light go on, and then it got hijacked.
My questions have all been answered. You guys are doing a fantastic job.
Okay.
Thank you.
Fantastic. So Matthew, I I was watching your podcast, which you did, with Tobias, and there you talked about a strategy. Now, we just saw in our poll that many of our viewers, they also use options. So can you explain what that strategy is, especially in today's market, when a lot of these businesses, great businesses, but they're a bit richly valued. So how do you position yourself to acquire them at your desired price? If you can explain that strategy.
Yeah, definitely. And just for full transparency, I'm sort of reading the chat and seeing the things pop up, but you'll have to fill me in because I may
don't worry about it. That Fan Liang, he will take care of those questions.
Yeah. So it's along the lines of our process, it's really just one step in acquiring the firms that we're interested in. So our process starts with you need to have some sort of pool of assets that you're looking at. You need to filter somehow. It's just impossible to analyze 10,000 securities. So as I mentioned, we use this 13F approach, and there's other strategies and there's other conversations I have or conferences that I attend where great ideas can sort of get filtered through and fall into this pool. And then there's this whole deep value fundamental analysis aspect where we try to understand what's the business model, what's who's running this firm, and what's the true intrinsic value, and would this be a good position in the portfolio. And then what you're mentioning is our third step in the process, which is how do we want to gain this exposure. And actually back when I was doing some a whole bunch of product analysis at Goldman for a few years, and going through like siloed trading desks and trying to analyze the different risk components affiliated with what they were transacting in, and recognize that even at that level, they weren't really combining the products in the most efficient ways, or in some cases even at all. And so what I do, and what works very well right now, and very well in any high volatility situation, is I will write a cash secured put as a tool to enter the security that I want to own. And so what that means is I will identify a position we would like to buy, the price that we'd like to pay for it. We calculate the notional amount, the emotional amount of the exposure that we'd like to obtain. And instead of just buying it through a market or limit order through, in the US, the New York Stock Exchange, I will go to the Chicago Board of Exchange and I'll write a put contract with a specified strike price, and I will charge a premium that somebody pays us up front for our commitment to purchase the stock if it falls further. So basically, if you're, let's say hypothetically, you want to buy $100 security because you think it's worth $200. So instead of buying it for 100 or putting in a limit order and buying it for 99, I will commit to buying it for 95 for 6 months and charge, say, a $25 premium. That would be pretty attractive. That would be a very high premium, but they do exist. And then we wait, and we hold, on the math I just did, we'd hold $70 in cash. We'd pick up 25 in a premium from our counterparts, and that would make the $95. That would cover our commitment to buy the security should they decline. And if they do, if it does go below 95, we now buy for a net cash outflow of 70. And if it doesn't go below 95, the contract ends and we keep the premium. So we would earn 25 on our $70 and get about maybe 35% return over, in this hypothetical situation, a 6-month period. So again, that's a very sort of I just made those numbers up. That's a pretty attractive situation, but you can pick up double-digit IRRs often going through this method. And by the way, this is, if the options are available, this is the only way I buy, as long as the IRR is sufficient. It doesn't make sense to me anymore to buy something with a limited market order when somebody will pay you to buy the security.
Do you target any specific IRRs, or is it more based on, I mean,
well,
it's all about choosing which strike and which duration, because these are the two parameters.
We get, it gets into these really detailed nuances pretty quickly. So, I've been doing it, this strategy probably since 95. And so at this point, I think there's all sorts of factors that I integrate that are maybe too detailed for this conversation, but that's exactly right. It's so if I'm not going to get a double-digit annualized IRR from the premium, it doesn't really make a lot of sense for us. I mean, we're investing in companies that have a lot of potential. So to sort of lock up capital and have something sub 10%, it's just not interesting. Because everything's opportunity cost of capital, right? So if I do A, I can't do B, and so I'm going to do B if A is insufficient. In fact, if there's something very attractive and the contracts aren't available, I'll just buy the stock. I mean, I won't not participate in an opportunity because I can't get the premium. But quite often, all you have to wait for is some sort of market event or some sort of individual firm event. And because volatility feeds into the black shoals, the volatility picks up, premiums pick up right as the share prices drop. A lot of things move in the right direction at the same time. So right as the price drops, volatility goes up, so you get a higher premium and a lower price. So a lot of times it requires just being patient. But yeah, directly to your answer, it has to be double digit something as a rule of thumb.
It makes so much sense, and it's also kind of harnessing the correction and the volatility in your direction rather than fearing it and frightened by the correction or volatility happening. This can actually put you in position to acquire.
That's right. That's right. And I encourage people to do it. In fact, for many, many years, I was so I was reluctant to share this strategy publicly. And by the way, if there are folks on the call that do it already, you should know it's a really rare thing, especially, maybe it's getting more popular now, but a decade ago or so, it was very uncommon to find somebody else who was doing this. And I where there's mystery, there's margin, is what Peter Kaufman says. So it helps to have like an inefficient product out there swinging around in a volatile way. But what I found is that over time, a couple of things. One is most people actually, they'll learn about it, and then it's rare for them to go and execute on it. Requires all sorts of unique characteristics, and maybe there's a lot of those folks on this call, but they need to have all this patience and be deep value investors and understand that when it goes down, they actually want to buy and they shouldn't be nervous. And then it also, but also requires like the financial acumen to be able to create the product and be comfortable and confident enough to be able to write it. And there's so many securities out there that it's actually more difficult than I imagined to sort of ruin this opportunity because whereas you may be looking at one security, I'm looking at something else. And so we can both be selling puts at the same time. But the market isn't, it's not as big as the equity market. I mean, this is a smaller niche space when you're out there selling these contracts.
In fact, Matthew, Vaibhav just did a poll, and you can see that this is one of the reasons why our viewers were very interested in speaking with you, because once you talked about it on the podcast, because many of our viewers actually, you saw 39%, they actually practice this strategy. And, I know some of them understand this pretty deeply. Now, I saw one question pop up. I'll actually take that question right now, because that is very relevant to what you're saying. So, what happens if it's, let's say, one of these high growth business and the share price just runs away? So yeah, you have achieved your IRR through your put, but after the put expires, and if you haven't been able to get assigned on that, at the same strike, because at the end of the day, if that strike is what matters to you, because that is where you want to buy the stock, you may not be able to get the same, replicate the same IRR. So what happens then? Is there something else that you do? Maybe buy a long-term call to also participate on that, or anything else?
Yeah, that's a great question. And that's where all of these details start to flow in. So if the company has a lot of catalysts, upcoming catalysts, and maybe there's operational or some sort of leverage involved where it looks like the price can move quickly, it becomes less advantageous to sell this long-term put, because you miss the potential upside. And that only has to happen a few times before you really start regretting selling puts and missing doubles. And so one thing that you can do, exactly as you described, in fact, I'll just explain very quickly. Depending on the pool of capital you have, you don't need to sell one strike price and one expiration date. Okay, so what I mean by that is, let's say you wanted to take a 10% position, whatever your pool size of capital is. You wanted to build out a 10% holding. Perhaps you would make 10 1% positions, all with different expiration dates. And on those different expiration dates, maybe you would have different strike prices as well. So you have in the money, out of the money, and at the money strike going out 6 months, 9 months, 1 year, 18 months, 2 years, and you just get this full matrix where it enhances your possibility of buying at least some of the securities, because you have some out of the money put contracts available as well. And, maybe the firm is likely a little volatile, so you'll catch some. So that's already one basic strategy. And then the other thing you mentioned is you can, and we do sometimes take a little bit of that premium and buy a call option, so that if it really does run, you can catch it. And a lot of times I'll do a barbell sort of call option for any of the more advanced listeners, where there's something very far out of the money. So it's very, very cheap, but probably going to expire without us catching it. But it just costs us so little. It's maybe out 3 years and up 100% plus, and it's literally a few pennies. But I also like owning, when we do the barbell strategy, I like buying the calls that are actually a few calls that are also deep in the money. So it just really lowers the cost. It actually gives you some embedded leverage, but you definitely are going to own those securities. And if it really runs away, you're always going to be able to buy those in the future.
Cool. That's fantastic. Now, talking about those companies, I know any discussion with you, Matthew, will remain incomplete if I do not pick your brain on some of the companies that you research and you talk about in your letters. So, Daily Journal. I know. You spent a lot of time, looking at the business, and I was talking to Manuel, and he had some questions about Daily Journal. But where did that also come out from some 13F, or how did you?
So the 13F is a broad stroke guideline, But a lot of times what the 13F leads to is it's not as concrete as it sometimes seems. So it's like a trail of breadcrumbs to something else. So the same managers and the same teams are involved at Daily Journal as are in a lot of the other 13F businesses. And so, you know, it's, but no, it's not something that comes out of the 13Fs. This is, you know, it's, I think in many ways it's too small to be in a lot of the 13Fs we're looking at.
In
So
fact,
how did you find the Daily Journal exactly?
So, I'll start by caveating this a little bit in a few ways, and I'll just be as transparent as possible. So you asked about so we'll get into Daily Journal in a second. You asked about trimming, and so typically it's pretty dangerous to talk about current holdings because of the commitment and consistency biases that exist. So if you go out and start explaining and pitching all these things when you receive conflicting information, your guard is up. And by the way, typically when you go out and say anything about any securities, most of the feedback you receive is arguments against your thesis. That's just, I think, human nature. So the only people that want to talk to you just want to tell you that you're wrong. And so you end up defensive and constantly sort of like beating the idea into your own head because you're defending it to all these different people. So that is the reason that you'll see a lot of, you know, the fund managers that are doing things thoughtfully will say, we don't talk about positions because of that reason. And that's the correct reason. There's fund managers that talk about their positions for the wrong reason, and that's that they want everybody to go buy it and then the price goes up. So there's that aspect as well. I think as you, well, depending on where you are in the spectrum, you start to become like Buffett. You know, Buffett wants the price of securities that he owns to go down because he wants to buy more. And so I'm the same. So I don't want, believe it or not, I don't want Daily Journal to go up right now. Eventually, I want it to go up.
Yeah.
You asked about trimming earlier, and so I'm gonna make this statement so that people don't go out and buy it right now. But Daily Journal is one that we actually recently trimmed because I know it so well. And when it got to a high price earlier this year, it became, you know, almost 20% of the portfolio. And I recognized it could be 30% lower pretty easily, or even at the same price in a year. And I didn't want to tie up that capital. So we trimmed a little bit of it, and we have, but I want it to go down so that we can buy that all back. So
Matt, can I just, I'm not sure if I can make it, if we're going to keep talking about the Daily Journal, I think a short introduction about the business would be handy, because there might be a lot of people that don't actually know the business. And after Rupam told me that he invited me to this conversation, I went on a binge watching session of almost every podcast you've been into, and about Daily Journal as well. About Daily Journal as well. And I found it really, really interesting, because everyone these days, sort of the value investor guys, follow the Buffett saying that I don't understand technology, so I don't invest in technology. This is the exception to the rule, or at least this proves otherwise. It's not Warren Buffett, it's Charlie Munger. They actually are making a huge bet on technology, on a SaaS business. So would you like to make a small introduction of what the business is like today?
And Matthew,
absolutely.
before you speak, just one context. The reason I specifically asked about this is, when we spoke, and I have read all your documents. I was very impressed with the research process which you and your analyst, he's Andrew. I mean, you guys, the kind of scuttlebutt. So in MoneyWiseSmart, we do extensive deep dive research. So I thought that there's a lot to learn from the extent to which you guys went, the pains you guys took. So I'll really appreciate purely for education purpose. And as I mentioned right at the outset, that none of the businesses that we discuss here is a recommendation. So please take it in the right spirit. Yeah, over to you, Matt.
Absolutely, it will be, and I appreciate that very much, Rupam. And but also it will be. It's difficult for me not to get passionate about it, which then people turn around and buy it, and there's so little volume. I think that it doesn't hit the price. So that's just the reality of the situation and world. So
let me interrupt you just to cool off the sentiment of the people that might want to buy it. That on his last, I think it was an proxy statement, on his last letter, Charlie Munger said that the recent share price of the Daily Journal was reached amid much speculative frenzy. So from his point of view, the recent all-time high, I think, or at least recent high, was pretty speculative.
So okay, so let's look very briefly. There's a little background here. So what is the Daily Journal? And let's look at it from the framework that I was talking about earlier. So who is the management? What is the business? And then what is the valuation? I think that sort of helps give people some context. So it's not hard to find Daily Journal if you are in these deep value circles, because Charlie Munger has been the partner of Warren Buffett for maybe 6 decades or something, and he has been running Daily Journal for 44 years. Daily Journal was bought. It was a newspaper business. So the Daily Journal is a legal newspaper, and Charlie Munger is an attorney by trade. And so Charlie and Rick Guerin bought the Daily Journal for $2 million 44 years ago. And with that platform, they then acquired 9 other newspapers. It became a 10 newspaper business. And everybody's really confused these days. If you know Daily Journal, a lot of people don't really know it exists, right? But if you start following Munger and everybody closely, you realize he runs this firm. It's publicly traded, of course, and people get confused because it seems like a newspaper company, but it's not a newspaper company at all. Newspaper business are really dying, and basically it became. There's several aspects to it. So first of all, who's management? So Charlie Munger's on the management. Jerry Salzman's been running the firm as CEO, CFO, treasurer, and secretary, which is strange, for 30 something years, maybe 36 years. Peter Kaufman's on the board, who's incredibly wise. And Mary Conlin is now on the board, which is amazing for all sorts of different reasons I won't get into. But so board and actually management of the firm is really, really high quality. So management's covered. You've got that in the bag. And the business was newspapers. It's become a few things. In 2009, Charlie and Rick Guerin bottom ticked the market, and they put all of their excess cash into about 6 firms. The portfolio today, primarily about almost 60% of it is BYD, Build Your Dreams. So it's the Chinese Tesla. They also own Bank of America, US Bank, and Wells Fargo. Wells Fargo and Bank of America make up most of the rest of the portfolio. They have a little bit of POSCO in there as well. So they have this portfolio, and the portfolio has become something like $350 call it 315 million, if you include some real estate pieces and 27 million they have in cash. And my numbers are not I'm not looking at anything, but these are pretty rough, but these broad strokes will work. So there's about 315 million in this sort of liquid assets. And then they've got the newspapers. And then there's this tech piece, which I'll get into. So what they've done is they used a little bit of a margin loan. They kind of started doing this tech build, actually 2 decades ago now. But they used a $30 million margin loan against their equity portfolio to acquire 2 subsidiaries and wind them all together into something called JTI. And JTI basically provides software for courthouses and agencies and municipalities around the world. So they have major contracts in Australia. They have them in Canada. They have them actually they're doing a build in Tasmania now. I've come across contract in Sierra Leone, and then primarily they're in the United States. And so this SaaS business has all sorts of unique aspects that I can explain or jump into, but then they have a little bit of debt, and their debt primarily is so unique. It's like 60 million is deferred long-term capital gains tax because their equity portfolio went up. And so that becomes float in a way. I mean, it's non-callable, it's 0% interest rate. It's the strangest kind of debt. And it's interesting in finance how we sort of treat debt all the same. So if you want to figure out some book value, something, you just chop that off. But really, it's leverage on their portfolio. It's really not anywhere near what a typical like revolving line of credit would look like from a debt perspective. So they have 60 there, and they have 30 in a margin loan. And so they have like 90 million in debt. So if you kind of net that out from the 315 that they have in their assets, and by the way, I don't know if this gets too confusing, you just interrupt, but that 315 includes 3 office buildings that they have in this real estate portfolio that's sitting on their balance sheet at like 17 million. And I've run comparables. It's more like that value's from 20 years ago. They just don't adjust. They're not in the business of marking their books up for any reason. So it's real, like there's so many little missing pieces of value that's just kind of hidden in here. So even that is probably worth 15 more today. I think 16 more exactly is what our comparables showed us. But basically, so you have, 90 million in debt and 300 and I want to say 300, I have the note somewhere, but 315, I think. Anyway, it becomes like, it actually, I'm not getting the numbers quite right because I know that net of debt, they have in excess of 250 in their equity and sort of these hard assets. And the whole business is selling for less than 450 million. So in our analysis, we've sort of said, forget about the newspapers. They have revenue. It's not worth 0, but just leave them out. The question really comes down to the future and new business, which is the technology business. And that technology business I described have contracts all over the world. I can get into some of the details, but there's basically the unique thing about this business is that there is all this off financial statement value because they have not booked revenue for so many of the contracts that they've sold and they're implementing to these municipalities and cities and states and countries around the world. And so they have this is a little microcap firm with a subsidiary. The tech piece in the market is selling for under 200 million, far under 200 million. And they have 35 million in revenue today. Our models show us they'll have about 100 million plus in revenue this decade. So it's just a very attractive situation.
That's fantastic. Especially of course, we don't have time to get into the further details, but if someone is interested, they can just take cues into the level of research that you guys have done, and that's absolutely commendable. So
Yeah, and I pulled it up here, by the way. They have 355 million. So 311 was just the equity portfolio. And then they have 27 in cash and all of this real estate. It becomes like 355 million. And the whole market cap is 450 million. So, I mean, you can remove this debt that I was talking about, but you still have this whole subsidiary for 190. You know, if you look at SaaS businesses today, they sell for 15, 20, sometimes 50 times revenue. The one being run by these some of the greatest business minds in the history of the world is selling for 5 times revenue.
That's, yeah,
And
that's amazing.
Rupam, I don't want to get too much into detail because I understand that there's a lot to talk about, but this is actually quite interesting because Matthew has said on previous occasions that he was trying to find, well, he was fishing on somewhere around the microcap pond, and he was trying to find value that is not stated on the financial statements. And this is exactly one example, and a pretty interesting example of such a situation, where by reading the 10K and by looking at the financial statements, you won't be able to find this. So that was, I was interested in knowing how he got there, and I understand that he has his circle of friends and other investors that chat, and that's great. That's one of the great things about investing, is the community that is created around an idea. And just to tell you, Matthew has gone through a big research process, because the company doesn't disclose who they're selling to this software. This is major. This is for courthouses, and but the courthouses, the counties disclose something. So Matthew has gone all the way around to find out to whom they're selling and for how much they're selling, and that isn't recognized today on the income statement. That will only be recognized after implementation, after some like 4 years after they get the contract. And because of this, they're expensing it all right now up front. So you see the costs, but you don't see the revenue coming in. So the whole thing, the whole subject of this thesis is that someday you'll get all of this work recognized, right, on the revenue. And the company, there's not a lot of companies that can do this, bear the costs up front and wait for several years to get the revenue. And I think this was brilliant. And I must thank Matthew for sharing his work on this one, because it's a hidden asset in plain sight, but it requires a lot of work. And I'm not sure if everyone, I'm actually sure that the regular guys like me can't do it, because he has gone through thousands of documents to find out the hidden asset and the actual value of the hidden asset. But so this was a brilliant one, and I must thank you, Matthew, for sharing his work on this one.
It's absolutely
Well,
fantastic.
Yeah, and Manuel, I'll comment on that for a minute, and because Rupam, you were also asking about the process, which I didn't really explain. Manuel, so you are correct. There is this circle of highly qualified individuals that I share ideas with on a regular basis. We all are sharing ideas, but in fact, the reason that Daily Journal piqued my interest, I have been following Daily Journal for over a decade. The first time we started investing was about 3 years ago, so you can imagine the extent of time. I mean, we are really slow moving, I think. But what I discovered is that about 3-4 years ago, I realized that all of these wise people I'm surrounded with had no idea what was happening at Daily Journal. And I didn't know either. And as I looked further and further, I couldn't figure it out, which was really surprising, because normally, you can pick up a stone and see what's underneath. And it was just so hidden that, you know, Kaufman's on the board, Peter Kaufman, and he's the one that says when there's mystery, there's margin. And this was so mysterious to me. And so I'll add to your comment. Actually, the first way that I finally learned something, even discovered what technology they were building, was I learned that there was a customer training conference happening in Utah. And I tried to attend, but I didn't have a court ID or a government ID. And so I flew there and I booked a room in the hotel, and I sat in the lobby for 3 days interviewing all of the customers as they took breaks between their seminars, and had coffee. And I realized all these incredible things. I mean, because I was there, they were sharing information with me, and I was learning that they weren't billing them yet, that these implementations were taking 4 to 7 years. I was learning that they loved the product. I was learning that the number of licenses that each courthouse was buying was exploding from 100 when they signed the contract to 300 when they went live. And so all of the numbers were totally wrong. And I recognized then that none of the revenue is showing up on the financial statements at Daily Journal if they haven't gone live. And so what Manuel's talking about is I brought in an intern, and we went county by county around America. There's 3,000 counties. And we tried to see from the county's perspective if they had some liability to Daily Journal or Journal Technologies. And it was an incredibly onerous process. But we found over 100 of these. You know, LA owed them $5 million. Austin, Texas owes them $1 million. They are owed money from Utah. Like, all of these counties and states owe them money. And so it's on their financial statements, but it's not on Daily Journal's financial statements. And so that became a huge process. And then I've actually gone through this massive campaign that began on LinkedIn, resulting in interviewing I must have contacted 50 or so ex-employees and some current employees. And I've actually spoken to the original founder of one of the subsidiaries that was bought by Daily Journal, creating this tech firm, and interviewed all of these employees to learn about their culture and learn about the management style. And by the way, there are some major risks. There are risks in the culture. There are risks in some of the code. And so I really know this company well. And yeah, so the research is extensive. And so, yeah, happy to share that with you.
Fantastic.
Let me just push you back a little bit. And this is the part you might become defensive. If you grab your presentation on it, I think it was on Manual of Ideas that you've presented it. If you grab, you've got a table with 20 different counties and their recurring revenue, right? And you've got the largest one, I think it's the Australian one. And if you add them up together, you get to 6 million in recurring revenue. Even if you, like you say, if there's 100 of these and you multiply it by 5, you only get to 30 million in recurring revenue. Where do you come up with this 150 million recurring revenue?
Yeah, that's a good question. So first of all, there are some really big contracts. So right now there's already 35 million in revenue. And this business is growing very quickly. So if you put a very low, I don't know what it is off the top of my head, but if you sort of have a 12 or 13% revenue growth over this decade, and they're growing much, much faster, you already get to 100. So you can start just from there. And whether it's 100, 150, all these things, they don't really matter. I'll circle back real quick to the valuation. I don't know if Rupam's trying to move on or not. No,
go ahead.
But you know, so bear with, I will explain. So Australia alone has 2 contracts where we know the price and 1 that we don't. And the 2 that we know is 89 million and 16 million. And about half or a little more than half of that is likely recurring and not showing up today. So there's 50 million in recurring right there when Australia goes live. But there's other things happening. So the most obvious thing that's happening, Manuel, is that they're still out there doing RFPs and getting more contracts. So that's the easiest, simplest thing is the number of contracts are growing, and the space is so big, and the systems in these courthouses, and I mean, this is government bureaucracy, and the systems are really antiquated, legacy. They need to be replaced if they even exist. I mean, it's bad. So they're in a space where there's really a necessity. They're solving a major problem, and it's enormous. So they have a long runway ahead of them. So they're doing more and more RFPs, so that's growing. But then what happens is once things go live, there's all these revenue factors that aren't in the contracts that you wouldn't really know about unless you really knew the business. But once the go live happens, what are some of them? Well, the number of licenses that are purchased increases typically almost starting right away. So a courthouse might buy the minimum amount that they need. They sign up to get 50 licenses for their courthouse, and that's in the contractual agreement. And that goes on for 4 years till they go live. But once they're live, they realize actually everybody needs a license. And so they need 200 licenses. So you see that revenue jump. They also have price increases built in. So all of the licenses are inflating each year at like 2.5% to 5%. Some of them are based on CPI, but it's all in the contracts. And these contracts are for 10 years, and then nobody switches because it's so ingrained in the system. So there's that increase. There's also something big. And in many cases, I've heard from folks at different like Microsoft and other places that this might become the main revenue source, is that once they're live, they actually have consulting fees to go in and do maintenance, but also to just support the needs of the customers. And they charge like $300 an hour, and it's just in the contracts, and none of that revenue can show up until they're live. They then have two now services, e-file it and e-pay it. E-file it basically allows you to electronically submit your documents to a courthouse, and you pay $4.99 or whatever. None of that revenue shows up until go live. E-pay it is anybody that needs to pay anything, instead of writing a check and finding a stamp as you typically would in the United States, you can pay with a credit card on the internet and pay $5, and everyone's going to choose that option. So none of, and that's just enormous. I mean, that's like millions and millions of dollars when people start using that. And most recently, they've started offering cloud hosting services, sensitive data cloud hosting services for the municipalities and cities and states and countries. So they get a margin on top of the AWS. So all of that revenue is just totally absent right now. It requires the go live. And then once the go live occurs, all of that can start happening. And so we have some broad strokes in the models, and I think it's going to be highly likely that they reach 100 or so million, and we may get some big surprises to the upside. And so that's sort of the approach we're taking. And by the way, if you have 100 million, Tyler Technologies is the main competitor. And I'm not trying to make a thesis really here, but I mean, it comes out anyway, but Tyler's the main competitor. Tyler has about $1 billion in revenue and trades for 15 billion. It's about 15 times revenue. The SaaS business, and we can talk about bubbles and et cetera, but anybody in this business seems to be trading for like 20, 25 revenue times revenue. They're trading for maybe 5 times revenue. So you can get multiple expansion. But if they reach 100 and just sell for 10 times revenue, which would be like below anybody else, it's $1 billion business. And then they still have the equity portfolio, which is today at 355 with their real estate and cash. And so that probably doubles or triples over the decade also. So there's another billion. So now suddenly you have 2 billion, and it's trading for like 450 million. So whether Munger says, we have frothy valuation, like I don't know about that. I mean, it's
Hasn't Rick Barron sold his position?
sorry.
Hasn't one of the board members sold his position recently?
Yeah. So Jerry Salzman. So a few things have happened. So Rick Barron passed away sadly last October, and he was one of the original founders. I mean, he purchased the paper with Munger. So they've been running it the entire time. Jerry Salzman, who's been there for many, many years, you know, he's 81. He works from home. He had a stroke, and he sold his entire position. But I'm actually really happy to see that Peter Kaufman bought 10% of the firm. So Salzman sold and Kaufman bought. So I don't think Salzman was selling for financial reasons. I think he was selling for something internal, probably. So yes, he's selling. Kaufman's buying. It's a wash. I don't find that to be an issue. But there are risks. Look, but the point is actually with Daily Journal is the asymmetry that's involved. So if the whole technology piece were to fail, okay, and they're not failing, but if they never got above 35, or if they actually went to somehow 0 and they couldn't like sell the software. By the way, internally, you know, 10 million lines of code, it has a lot of functionality. I mean, they could sell it, right? There's been discussions on that kind of thing. So it wouldn't be a 0 at all. But if it were, they would still have this equity portfolio and the newspapers, we forgot about those, but the equity portfolio itself over a 5-year period or less, remember equity is 355 with real estate and cash, and the whole market cap's 450. So, and then they've got the debt. So take out all the debt. Now you're still at 265. How long does it take this portfolio from 265 to 450? I mean, 4 years from now, your equity portfolio is as big as the market cap, which I think puts a very nice floor on this. And then you've got all this, you've got high quality managers and all these hidden call options inside of the business, and some real potential for the SaaS business to really break out. You know, if they end up at 200 million, by the way, in a decade from now, they'll still just be starting. I mean, they won't have saturated any sort of market. So a decade from now, if they do end up at 100 or 150 or even 200, and they start trading for a 15 multiple, I mean, now you're talking about a $4 billion business. That's almost a 10 bagger from here. So it's like the asymmetry is what's attractive. This muted downside, very protected downside, with a very attractive upside.
Very, very interesting. In fact, you know, again, I mean, what I really take away from your description of how you guys went about finding the hidden value is the sheer quality of research. And you know, for our viewers, for all our subscribers of MoneyWiseSmart, you know, this is the kind of research which gives you the conviction. You know, it just is not possible based on borrowed research, and that is what, you know, we try to teach in MoneyWiseSmart. Okay, so I think now is the time to hand over the mic to Fan Liang. Fan Liang, I see quite a few questions have come in. So Matthew, you're okay taking some questions, and the other panelists as well?
Yeah, that sounds great. I'll
All
do
right.
my very best.
Great.
I'm sure you will. So we have got quite a lot of questions coming in now from the past two. And if anyone have any more questions, feel free to pop them in. So the first one we have is from Max. Max is saying that right now it's difficult to look into the future of technology companies. Warren Buffett himself has said that he's skeptical of someone who claims that he can look into the future of technology companies. And since the valuation of these technology companies depend on future cash flows, how do you determine whether a company is undervalued or not? If a company is trading at 30 times PE and the earnings will double in 2 years, then it's a no-brainer. But what if a company trades at 100 times PE? So I think it's open to the floor. So maybe Matthew, do you want to take it up first?
Yeah, I can address that to some level. Look, it's a good question, and it's a tricky time, difficult time. But in my experience, it feels like, and this is sort of the third crisis that I've been investing in professionally. But even when there's not a crisis, for those who maybe are younger or haven't been doing this for a long time, it's always a difficult time. It's always a tricky time. I mean, everyone always says, oh, well, in this situation, there's this unique aspect, and so it makes it so difficult. But tomorrow there will be a new difficult reason why people are struggling to determine value. And a lot of times that's why assets, they say, there's this phrase like the equity market climbs this wall of worry. But really what's happening is that everybody's worried and concerned about a number of fearful factors. Today, I'm pretty sure actually, I don't know. In the US, we are pretty quarantined and everyone's sort of locked in their houses. And I think in many places in the world, that's the case right now. Some places have handled the pandemic better than others, but it's a very fearful time. But as vaccines roll out, as politics become a little different, as we evolve out of this economic recession and situation we're in, it's not that stocks will climb the wall of worry, it's that the worries will go away. And so then people will become more comfortable investing in risky assets. So because we have a concentrated portfolio, meaning because we only have to own 10 or 12 securities, we don't have to buy the 100 times earnings securities, and you don't have to buy them either. If you only have to buy them if you analyze them and see something that looks attractive. And so more what I'm looking for, there's two other little tricks I like to use. And basically, the first is to find a great business model and then look around the world and see where else it exists. Because you can find companies in different countries that maybe have really attractive economics, but in that local area, they haven't been fully appreciated yet. And in fact, we had a situation like that with JD.com. So a few years ago, Amazon was just taking off. JD.com was struggling, but their revenue was just growing enormously. They had a great business model, great businesses, and so it was very, very attractive. So you can look in other areas to find things that are trading for lower multiples. But also what I really like in it, you can see this just in the daily journal analysis, is I don't want to buy the 100 times earnings. Maybe it's just like the old Ben Graham issues. Like I'm not that open-minded yet. So what's more attractive to me is to find a hidden subsidiary with those business dynamics and economics inside some legacy business. So it's sort of camouflage or disguise. And at some point there needs to be a catalyst, or maybe there's a spin out or something gets released to let that sort of shine. And so that's, I don't know, that's my answer. I avoid the ones trading for 100 times earnings usually, unless I can really find something that strikes me. And that's just how I handle it personally.
Interesting. You talked about JD.com. I know there is a pretty significant amount of JD.com wealth in this Zoom call, because that's a question. That's a company that we analyzed in absolute great detail. And again, coming back to research, I mean, that was the time when the JD stock price, I remember, was like going down every single day, and we kept buying simply because we understand the nuances of the business. I mean, we realized that if someone looks at their the fact that they were growing their gross margins and all those things were visible to everybody, but if you look slightly in detail in their cash flow statements, we realized that even their change in working capital was large enough to pay for their large capital expenditures, and they were, the kind of moat they were building, it's unbelievable. So, even if you completely ignore the several businesses which they have, spun off, like JD Logistics, JD Health, JD Technology, I mean, again, one amazing business. And I'm sure there are several happy investors who have been buying even around 1920 and stuff like that. I think right now it's around 95. All right, so what's the next question, Panya?
Yeah, I've sent you the question, Rupam.
Okay, all right. Yeah. So there is a question from Derek. How do you think about portfolio allocation? Do you try to keep multiple uncorrelated assets? How many positions do you hold?
And to me, right?
Yes. Yeah.
Well,
you're still on the hot seat, Matthew.
Yeah, that's fine. I'll keep going as long. Now we're getting into real morning here, so we can
get some more coffee if you want.
So no, I'm ready now. So it's a very good question. I will tell you directly, I'm not trying to check boxes or fill a whole bunch of different sectors. That's just not what we're doing. If everything that we found and everything looked attractive in one space, we may be pretty concentrated in that particular sector. So there's nothing requiring us to be in any particular area. However, I do find it prudent to have, because there's unknown unknowns. There's people who know they don't know, and there's people who don't know they don't know. And at least we know we don't know. So there can be externalities that affect things in unexpected ways. So it's prudent to have some different characteristics within the portfolio. So we have incredibly diverse cash flows, and I do pay some attention to it. If there are two ideas and they both look similar, and one creates this whole new diversity in terms of future cash flow in our portfolio, and the other is similar to an existing position, I'd prefer to have the diversification. The types of things we have are very rare and unique. Okay, we have, first of all, we're using puts and things, so we're creating these premiums to get into these firms in many cases, but we own, for example, Daily Journal. Okay, that revenue comes from like municipal tax income. We have stuff from Berkshire Hathaway, which is a big broad base. We own 3% of a firm started by Manish Pabrai, which is Dondo Holdings. It's actually a private entity, and this entity inside of it has $100 million hedge fund focused on India. So we own the business sitting on top of that hedge fund. That's an incredibly diverse sort of source of revenue. Similarly, we actually set up a capital pipe. My wife is from Istanbul. We have a capital pipe that goes out to the Middle East, and we own a bunch of companies like, we have a portfolio over there. Talus Capital is a fund we have over there. And we own things like the Coca-Cola bottling company of the Middle East through that capital pipe. So these are we are looking to have we have no mandate to have diverse cash flows and revenues and businesses, but it is prudent to, I think about things in that manner. So, so that's, high level, that's the approach we take.
Okay, excellent. All right. So the next question is, how do you judge the quality of management, especially if you're a small investor or a retail investor and do not have the opportunity to talk to management? You as a fund manager can probably pick up the phone and management will answer. But a serious retail investor, what would you advise him or her? How do they go about studying management?
It's a great question. First of all, if they have any sort of track record, a lot of times management has moved between different companies, and you can see if they're taking firms public or taking them into bankruptcy. So you can just look at what they've done in their own history. But really the easiest way is to just listen to a few earnings calls and try to evaluate the language that they use. So if they're talking about, per share intrinsic value growth, that's a pretty good sign that they have some value-based orientation. If they're talking about making a acquisition to keep up with their competition, who's making a similar acquisition, I mean, you might question a move like that, depending on the situation. So I pay a lot of attention to the language that they use. They need to be really focused on per share growth. And also, what is the skill set that you really want management to have? I mean, in my view, it is enormously important that they are great at capital allocation. And it's a skill that a lot of managers lack because if you climb the ranks to become a member of the C-suite, you have all sorts of skill sets, but some of it might be in politics, corporate politics. You're probably good at sales. You've done a lot of things right. You have a great pedigree, but the real way to create or ruin capital, if you have a great business that's throwing a bunch of capital at the management team, their job is to now allocate that. So they have to be great capital allocators. There's only a few things they can really do. They could pay it out as a dividend. They could invest it back into their own business. They could go out and acquire an outside business. They could pay
buy
off
back
debt, or they could do buybacks, right? And if you sort of think about, okay, those decisions properly are what create this sort of compounding machine that allows things to continue like a Phil Fisher sort of compounder. And so, you can listen for those types of words in earnings calls. You can look in the annual report. And so those are a few things I think you can look for. I don't think you need to talk to management one-on-one necessarily. And a lot of times if you did, they're going to be so good at sales that it might not even help.
Yeah. Okay. Next question is from Josh. He asks, so do you generally sell the puts only on businesses that you would want to own, or do you also sometimes do puts on, let's say, the indices just for cash flow purpose?
So I don't do them on the indices. For the purpose of this call and the 99% of the time, we are looking to fully purchase the businesses. That is the intention. We are only selling these puts on businesses that we want to own. There have been a few exceptions, and I'll briefly say, we had a hedge at one point where we were hedging using this strategy where we bought some out of the money puts on the S&P 500. We actually bought them when volatility was really low a few years back. And then we sold really far out of the money puts as a tool to pay for the puts that we were using as our hedge, because if the S&P really fell like it did last March, at some point we become a net buyer. And so there's this like small sliver where we're using it to pay for something. But typically, if you use it as a strategy to acquire shares that you want to own, I think that's where you're going to find the biggest, you're going to get the biggest advantage.
Awesome. The next question is again option related. It's from Max. He's asking, how do you decide on the expiry date? Which expiry do you typically look for? Is there any?
There are a lot of factors that go into that. If they have, if there's a catalyst coming up, there could be dividends, there could be some catalyst, business catalyst coming up that's going to really change the dynamics of things. And so those would all impact it. But typically we will go out very long. I mean, as long as possible. So now there are, contracts that go out till 2023. You get paid for time. So we'll go out pretty far, 2 years, we'll get paid for the time. That's typically how we do it. And again, you can create a whole matrix around it. So it doesn't all need to be on one expiration date. But yeah, so historically, and the easiest approach is to go out as long as possible. A lot of people don't have that much patience, but that's typically what we do. If they really run away from that price and you're out a little bit, a year or so, you can put the contract back on and you could sell another. So.
Okay, awesome. Next, we have a question from Andre. It's a question on books. He's asking for some book recommendation. In fact, that was also a question that I wanted to ask you. Tell our viewers some of the books that you read and, what are your favorites, especially if you have any book recommendation on the options strategies that you're talking about. But, even if you have recommendations on other books, please feel free to tell us.
Yes, I can recommend quite a few books, or I won't give you a library behind you. Yeah, just this list. No, look, let's start from the basics. I think everybody would benefit if they haven't already in reading, obviously, like read Phil Fisher's
Common Stocks
method.
Okay.
Thank you.
Yeah.
Common stocks with uncommon profit. I know the concepts, I just don't know the title. No. So common stocks with uncommon profit, and of course, The Intelligent Investor, and then I would probably make sure and read Poor Charlie's Almanac, which is written by Peter Kaufman, and it's all of Charlie's views. But there's a lot of really great books. I enjoyed a few years ago. So also we talked about Howard Marks. Howard Marks has 20. He has market cycles.
Yeah,
and then he also has the most important thing, right? Which is great. Most important thing is great. So Ed Thorpe has a really fun read out there, A Man of All Markets, or A Man for All Markets, I think it's called. And that is almost like an autobiography. And for those who don't know, Thorpe ran a very successful hedge fund, but started his years. He was the original professor who kind of brought the MIT team down to Vegas. Beat the house. Beat the house. And he's credited with the first wearable computer because he had a roulette device that they had in their shoe, and they were beating roulette, many decades ago. And he truly is. He has the first wearable computer. So it's just fantastic, fun book to read. Annie Duke wrote a great book. She's the famous poker player, Thinking in Bets, about probabilistic thinking, about how the outcome isn't always determinant of the decision-making quality of the decision. Let's see, Ray Dalio has a great book, Principles. I know. Yeah. And then there's two versions. So there's The Outsiders by Thorndike.
Oh yeah, talking about the greatest capital allocators. In fact, I talk about that. Fantastic book.
All these. I also recently enjoyed, or a couple years ago now, I guess, there's Factfulness. Have you read
Loved it.
Factfulness?
Absolutely.
Yeah.
Absolutely. It's, I was just looking for the book. It's one of the greatest, Hans Rosling. Yeah. In fact,
Yeah.
I posted about that book on our forum. Yeah.
Great,
amazing.
great.
Every investor should read that book,
Yeah, exactly. I mean, that's just a handful. I'm missing, so many, but Stocks for the Long Run by Jeremy Siegel is a great book, actually. Jeremy Siegel is the head professor at Wharton University and finance professor chair, and he analyzed 200 years of data of all these different asset classes and just shows sort of what has happened to gold, what's happened to currency, what's happened to treasuries or government bonds, corporate bonds, and then stocks, and kind of makes this enormous case for owning stocks for the long run.
Fantastic. Yeah, I saw that analysis. So Matthew, if I may take the liberty of maybe later after this session, pestering you to email me your book list or anything that you may have so that I can share with the viewers here, they will really benefit from that. Any book recommendations.
Yeah, remind me afterward. I can
that'll be
put something
fantastic.
Together.
Okay, fantastic. Okay, so the next question is from Connor. He says, Mr. Peterson, after doing such extensive, deep analysis, how do you know, that is, when to pull the trigger? And how do you know when you understand the business well enough to be willing to make a sizable position? So when is that magic moment? When okay, now let me go and put in the buy order.
These are really good questions because it comes down to there's naturally some art involved in this science, and it's hard to. So I try to make things as objective as possible in my decision making, but it's a very good question because it's a very hard thing for all fund managers, portfolio managers. What I do, I can just share what I do, and I'm not sure it will be improved over the years. Eventually, after I've done enough research that I'm pretty comfortable, I will take about a 2% position. That day, that time, I typically put in orders after the market is closed. A lot of times it's done on a weekend, so there's nothing influencing my decision making. If we're selling puts or using a limit order, but primarily if puts are available, selling puts, we're putting them. The price of puts are so volatile that we will price them. We will put in a limit order and price them at much higher prices than are currently in the market. So it doesn't mean that we take the position the day that we list it as a limit order. Sometimes that position will sit there for months before somebody buys it from us. But we typically will start with a 2% position. Once there's a 2% position, what most investors find is that it really focuses them on their research. Suddenly you care a lot more about details, like what's the competition doing in response to some event. And so after that 2% position, I will upon determining that it is a correct decision, we'll take it to 5 and then to 10. So when does that happen? It usually happens when there's a big dip or an irrational event that takes the price down and it looks even more attractive. So typically we move in with 2% and then 5%, and then we'll take it to 10% if we really like the holding. And it's done through very far, like out of the money sort of limit orders using puts. So we're getting really good prices. And but that's about all I can say in terms of formula, because it's very tricky piece of the business.
Fantastic. Okay, so the next question is from Dr. Raymond Tham. He says Buffett indicator, that is the market cap to GDP ratio, is at an all-time high, even higher than the peaks of 2000 and 2007. What do you say to people who say that this time it's different, and how would you position yourself if you believe that we are in bubble territory? So I think he's, as you, I mean, do you believe that we are in bubble territory, and how do you see the current, market levels?
Sure. Okay, these are all great questions. It is very hard to say if we're in a bubble or not. I don't think we're in an immediate bubble, but I think some firms are. Look, some firms are overpriced, some firms are underpriced, some firms are accurately priced. That's what I can say. And we don't need that many positions to fill our portfolio. So we're focused on the ones that are hopefully growing and underpriced. And you can think of those just as the few examples we've gone through. And they're certainly growing, and they're cheap and good firms. So I'm very happy holding those. In fact, we're fully invested. I'll go further, actually, to say a few things. First of all, the Buffett indicator is interesting. I understand that it's high. I think the dynamics of the world are a little, I think it can actually go higher. Here's what I think is going on. We have, and this is from a US sort of Fed and Treasury perspective, but we have just gone through a massive stimulus. There's a few things. We have just poured $8 trillion around the US in all sorts of factors. And we've done it in a way that puts a lot of cash directly into the bank accounts of citizens. And it's very different from what happened in 2009. So in 2009, there was this famous period where Hank Paulson was like on his knees begging for $700 billion. And that was then given to banks to sort of restore their balance sheets, because Lehman was going down and all these things were happening. And then the trouble was getting them to lend it. So their balance sheets were secure, but none of the cash went out to the citizens of the US. In this case, they learned from that, and they put it directly into the bank accounts. They sent checks to everybody. They did PPP loans to all of these businesses, and they delivered $8 trillion, and nobody can get out and do anything. So the money market accounts in the US have been flooded with cash, and it's earning 0% because the Fed brought the interest rates to zero. So there is now about $4.5 trillion, up from maybe $2.5 trillion 2 years ago or a year ago, sitting in money market accounts earning zero. What that means is the Fed, and by the way, the Fed's shifting some of their focus. So the Fed has in the past targeted a 2% annual inflation rate. I realize we have a big global audience here, so bear with me. I know this is US sort of thought process, but in the US, there's historically been a 2% inflation target, and that shifted recently. Fed Powell about 6 months ago changed their statement, but just so slightly and so subtly, but now they talk about an average 2% target. And what that means is that if inflation creeps up this year, which look, everyone's been trying to say inflation's coming for 10 years because we keep dumping money. And I don't know what else happens. You pour money all over the economy, things are supposed to cost a little more because everybody has more money. It's just supply and demand. Hasn't happened. There's been pressures keeping it down. But if inflation does start to tick up, and I could be wrong, but I do think it seems like that's appropriate. I don't think the Fed raises rates. And what happens is everybody with their cash in the money market accounts, capital has to go somewhere. So it's going to move into risk assets. Yeah, some will go into Bitcoin, some will go into real estate, but not very much is going into bonds because bond rates are so low. So even though maybe securities are fair or high, some people I think are going to be pressured into taking their cash and taking their bonds and putting them into stock. And that can drive the markets higher. So, you know, and then of course we get to just select our favorite few. So I've actually never owned Tesla. Is Tesla a bubble? I don't know, but I think it's probably pretty, I mean, certainly if it's a car company, it is. If it's an energy company, I mean, we'll see, but it's quite expensive from how I see it, but I just get to ignore it. So we just skip it. And so yeah, I think I sort of expect that the markets will do well this year, actually. I think that it's a great, I think we're at the beginning of a great wave in equities. And so I'm not too concerned about the bubble popping.
You know, it's very interesting you say that. I mean, if I may just
Rupam, can I add a couple things?
Sure, Jonathan, please go ahead.
No, I see people talk about the Buffett indicator quite a bit, and I see people talk about the Shiller PE. And, you know, we were just talking about kind of growth and value joined at the hip and kind of Howard Marks with the memo and kind of slow to adapt to certain things as value investors. And so I think this is something we need to hone in on as value investors. And that is, these indicators very well could be tired, they could be old, and they're definitely not all encompassing. And what you have is, you had in 2019 in the summer, Buffett himself basically said, and this should be a hint, you know, if interest rates stay this low, stocks are a bargain price. And the Buffett indicator, well, then was at an all-time high, now probably higher. But it doesn't take interest rates into account. And then I think about a month or maybe 2 months ago, Robert Shiller himself came out with an article basically adjusting CAPE for interest rates. And it was kind of a soft retraction of the Shiller PE, owning up to the fact that it hasn't worked for decades. It's not a useful figure. And so if it's his own metrics is called the Shiller PE, if he's not using it anymore, why should we? And you know, this morning I'd recommend this for everybody. Aswath Mordrin, he came out with a video valuing the S&P 500. He does think it's overvalued, but slightly, and he uses an equity risk premium approach, and he talks about that. I recommend everybody to check it out.
In fact, great you mentioned about this, Jonathan. I was actually going to, you know, refer to the article which you had posted, and I read it, and it's very interesting. Just a week before that, I was having, you know, a debate with someone based in Australia in another group, and you know, he quoted the Shiller PE, and I sent that article to him. I said, you know, you should read this. I mean, I didn't have to say anything more. Anyway, so moving on to the next question, we have a question from Mahendra. He also is talking about Buffett indicator. Yeah, he's asking, do you have any hedging strategy? I mean, you might not have directly talked about, yeah, any hedging strategy. Do you?
So we don't have a hedge overlay always, but when things present themselves, we are opportunistic. So if this individual has gone back and read the letters the last few years, we put on a hedge because basically I've been looking at I've been selling puts as a tool to enter for so many years that when we saw the VIX drop to like sub-9 levels and persist at those levels for multiple years, the premium shrunk to such a level that it was like we couldn't find these double-digit IRRs. In fact, sometimes the IRRs were so small, and it did take, you know, I'm very careful to change I'm slow to change my mind on things. I'm slow to adjust like really big strategies, but this became a scenario where it looked like maybe we needed to be doing the inverse of what we were doing. I mean, if we're always selling puts because they're systematically overvalued, and suddenly I recognize we can't find premium sufficient in anywhere, maybe we should be buying these. And so that's when we started buying out of the money puts with really long durations and using some really deep out of the money puts as tools, selling those as tools to pay for that. And so we did build that hedge, and the hedge worked pretty well. It was long-term hedge. And then, by the way, we have some natural hedges in place. Some of it is just, I mean, you get hedges if you have contrarian positions, but some of our hedges are things like selling calls on a position that's run up considerably, having an out of the money call. And that just is natural. You know, if you're going to exit at a certain level, you can write that call in advance. And that becomes a natural hedge, because if shares do decline and you have maybe 10% in premium weighting, you still capture that premium, becomes a little bit of a hedge. So there's some subtle hedging going on. There's some indirect hedging going on, and there every once in a while is a direct hedge, but it's not like a mandate. We're not actively looking for hedges.
Fantastic. Okay, the next question is an interesting question from Kang Zhang. He says, effectively what he's saying is, it's a decision-making related question. How do you protect yourself from overconfidence? Do you use any inversion technique, like, you know, what Charlie Munger keeps saying? I mean, do you ever question that, okay, you know, I feel too confident about this, so could I be wrong?
Yeah, it's a great question. I haven't. I mean, some of it is in the sort of principles of sort of arranging your environment to avoid those things. So by, for example, not talking about existing holdings publicly to avoid creating the biases of commitment and consistency, that the underlying intention is to reduce overconfidence. In Daily Journal, I specifically was afraid of suffering from underconfidence and not holding the position long enough. So I made a conscious decision a couple of years ago that I'd be comfortable talking about it publicly. And so, you know, how do you avoid overconfidence?
Like, do you bounce off ideas with someone? Do you know, take other people's feedback, or is it mostly a solo kind of a?
You know, just as I think in any industry, if you worked in law, you'd constantly be discussing things with other attorneys, and if you worked in medicine, you'd be discussing things in various conferences and things. So I have over the years created a very strong network that's enormously valuable. And it happens organically and it happens intentionally. But, you know, there are groups that I'm a part of, like the 10K group in Los Angeles, which is just full of, this is not like a running club. This is your 10K annual report club. Yeah. And it's full of great analysts, and we're always discussing ideas and debating ideas. You know, I'm very fond of this Value X conference run by Guy Spear out in Switzerland. I've been attending and speaking at those conferences for, I don't know, probably six or more years now. And then of course I have great friends, you know, some of my best friends are fund managers themselves. And so it's not only, you know, that it's just an ongoing constant dialogue that's happening between all of these various groups and individuals. So I'm certainly discussing ideas, bouncing things, sharing ideas. The nice thing about this business, especially if you're looking at companies of some size, it's really scalable. So you can just share the idea, and typically, with the exception of some micro caps, it's not really going to move the price. You're not going to get squeezed out. So you can be really transparent and open. And I think it's a common trait in value as well. I mean, you know, it's more, by the way, value investing philosophy, I think, is more than just finance. I think it's about compounding all sorts of things in life. It's compounding
Absolutely.
knowledge.
Absolutely.
It's compounding relationships, and it's and you tend to get people who are much more humble, I think. Perhaps they're open-minded, so you're willing to accept feedback and reconsider things. So, so the environment itself bodes well for, I think, avoiding overconfidence to some degree. But it's an issue, you know. So we take certain deliberate steps, like not discussing everything publicly because you get too defensive. But yeah, it's a good question. So there's a lot of biases. We're all human, so you have to counteract those.
Fantastic. Wow. We have almost we're almost reaching 2.5 hours. So that was amazing. We don't have any more questions as of now. Matthew, it was absolutely amazing. I think you have been extremely generous with your knowledge, with your time, and I don't know how to thank you for that. Now, just one last thing: if anyone wants to find out more about Peterson Funds, about what you guys do, what's the best way to reach you?
Yeah, sure. The best way to learn more is to visit our website. So you go to petersonfunds.com and you'll find.
Okay, sorry, can you spell it out? PE?
Yeah, PET. Here, maybe I'll write it in the chat. PETERSONFUNDS.
Okay, one word. Excellent. All right.
Oh, thank you. Thank you. I appreciate some.
Yeah.
Okay, so petersonfunds.com. I have 10 years of letters. There's a lot of information on that website. We also recently, in fact, Andrew recently consolidated and created a YouTube channel for us. So if you want to, if you prefer to just absorb some of these talks and things over the years, on YouTube, you can search Peterson Capital Management. It should come up, or maybe someone can put a link in there. But some annual meetings. We did an annual meeting virtually this year, so we posted that on our YouTube channel. And there's been a number of podcasts I've been involved with over time. That's a great way, I think, to learn more. And then I'm happy to have conversations, particularly if people are interested in participating in the fund. Typically, we do have some international LPs, but we really have, currently, because we're a U.S. Based fund, the LPs receive K1s, which means you file a U.S. tax. You typically file a U.S. tax return. So usually we get most interest from U.S. based folks or people that are filling out U.S. tax returns anyway. But if anybody wants to talk about that, you just send me an email, and happy to have those kind of discussions.
Fantastic. In fact, I have read a lot of your letters and the stuff that's on your on your website, and I can highly recommend. I mean, there's a lot of intellectual value in what you write. So thanks a lot. And yeah, guys, if you can respond to this poll, which Vaibhav has. I myself benefited a lot. I hope you guys benefited too. And a special thanks to all the panelists. You guys have been absolutely amazing. Matthew, you have been a rock star today.
Thank you.
Yeah, it must be tiring, but thank you so much for agreeing to do this for us. And guys,
no, this was a lot of fun. I'd love to meet, some of you in person once things open up.
Definitely, you have to come to Singapore. Maybe we will do a live session, and we'll take you for some absolutely authentic, local food.
That would be so delightful. You'll be surprised when I show up and say, here I am.
You're most welcome. We'll do a session, and everybody, what we are going to do is just give us a day or two. We have the recording, so we will publish it. We'll publish on all the groups that we are in, also the YouTube channel. Matthew, I'll be sharing it with you too. So feel free to share it. It has been really, really great.
Thank you.
Okay, guys. So we call it a day. Thank you, everybody, and stay safe and have a great evening, afternoon, or day. Thank you so much.
Thank you. Thank you.
Bye bye, everybody.
Follow Matthew Peterson at his website and YouTube channel with the links included in the video description below. If you have enjoyed this video, please smash the like button below and subscribe to our YouTube channel. Join our investment forum at Facebook. Link in the description below.